Today, we're going to examine a story that has sparked intense discussion across the precious metals community, a story summarized by the headline, "Only two silver bars moved as China forces Comex into physical reality." But this isn't just about two silver bars, it's about what physical demand may reveal, how futures markets interact with real-world supply, and why investors around the world are paying close attention to the relationship between paper contracts and physical metal. The real question isn't whether a headline sounds dramatic. The real question is, what do the data, the market structure, and the underlying trends actually tell us? Let's explore the evidence together. When people first enter the world of precious metals, one of the biggest surprises they encounter is that there are actually two very different ways to participate in the silver market. On one side is physical silver, the tangible metal you can hold in your hand, store in a safe, or keep in a vault. On the other side is paper silver, a broad term used to describe financial instruments whose value is linked to silver, but that do not necessarily involve taking possession of actual metal. Understanding the distinction between these two forms of ownership is one of the most important concepts for anyone interested in silver investing, because although they are connected by price, they often serve different purposes and involve different opportunities and risks. Physical silver is exactly what its name suggests. It includes bullion coins issued by government mints, privately minted rounds, investment-grade bars of various sizes, and even industrial-grade silver products. When someone purchases physical silver, they become the direct owner of a tangible asset. There is no intermediary required to maintain ownership after the transaction is complete. The investor has something real that exists independently of a brokerage account, electronic ledger, or financial institution. This characteristic has historically made physical silver attractive to individuals who value direct ownership and wish to reduce dependence on the broader financial system. Paper silver, by contrast, represents exposure to the price of silver through financial products. These can include futures contracts, exchange traded products, mining company shares, options, and other market instruments. Each of these products has its own structure and purpose. Some are designed to track the spot price of silver as closely as possible. Others provide leverage, allowing traders to control large amounts of silver exposure with relatively little capital. Still others offer indirect exposure through companies engaged in silver exploration, mining, or refining, although these products are commonly grouped together under the phrase paper silver. They differ significantly in terms of risk, liquidity, and ownership rights. One reason paper silver became so popular is convenience. Buying and selling physical silver requires transportation, storage, insurance, and security. These practical considerations can increase costs, particularly for large investors. Paper instruments eliminate many of these logistical challenges. A trader can buy or sell exposure to silver with a few clicks, often paying lower transaction costs and gaining immediate access to highly liquid markets. This convenience has made paper markets central to global price discovery. Liquidity is one of the defining characteristics of paper-silver markets. Every trading day, enormous numbers of contracts change hands as investors, institutions, manufacturers, refiners, and speculators respond to economic news, interest rates, inflation expectations, currency movements, and geopolitical developments. The volume of these transactions often exceeds the quantity of physical silver that changes hands on any given day. This difference does not necessarily imply that the market lacks integrity. Rather, it reflects the fact that many participants use financial contracts for hedging or speculation instead of intending to acquire or deliver metal. A futures contract, for example, is a standardized agreement traded on an exchange that specifies the future delivery of a certain quantity and quality of silver at a predetermined price. While these contracts include delivery provisions, many market participants close or roll their positions before delivery occurs. Producers may use futures to lock in selling prices, while manufacturers may hedge anticipated purchases. Investors and traders may use them to express views on future price movements. As a result, the majority of futures activity concludes financially rather than through the transfer of physical metal. This distinction often leads to misunderstandings. Some observers see the high trading volume in futures markets and assume that every contract represents a promise to deliver physical silver. In reality, futures markets are designed primarily as risk management and price discovery mechanisms. Delivery remains an important feature because it helps connect futures prices to the physical market, but not every participant intends to complete that process. Understanding this design is essential when evaluating claims about the relationship between paper trading and physical supply. Physical silver ownership introduces a different set of considerations. Investors who hold bullion must think about secure storage, insurance, authentication, and liquidity. Reputable dealers, recognized refiners, and widely accepted products generally command stronger resale markets. Premiums above the underlying silver price may rise or fall depending on demand, manufacturing capacity, and distribution conditions. During periods of heightened retail demand, premiums can increase even when the underlying spot price changes relatively little. Conversely, calmer markets may see premiums narrow. Storage is another important factor. Small investors often keep modest quantities at home using safes or other security measures. Larger holdings are frequently stored in professional vaulting facilities that provide insurance and auditing services. These arrangements introduce ongoing costs but may improve security and facilitate future resale. The choice between personal custody and third-party storage depends on an individual's objectives, resources, and risk tolerance. Counterparty risk is frequently discussed when comparing physical and paper silver. Counterparty risk refers to the possibility that another party involved in a financial transaction fails to meet its obligations. Certain paper instruments involve financial intermediaries, custodians, clearinghouses, or issuing institutions. Physical ownership generally reduces reliance on those intermediaries once the purchase is complete, although storage providers and dealers can still play important roles. Different investment structures involve different degrees of counterparty exposure, and investors should understand those differences before making decisions. Another major difference concerns purpose. Someone purchasing physical silver may be motivated by long-term wealth preservation, portfolio diversification, or a desire to own tangible assets. A professional trader using futures contracts may be focused on short-term price movements, hedging commercial exposure, or managing financial risk. Neither approach is inherently superior. Each serves different objectives. Problems often arise when investors assume that one form of ownership provides exactly the same characteristics as another. Price discovery represents another important concept. In modern markets, prices emerge through continuous interaction between buyers and sellers across multiple venues. Futures exchanges, physical dealers, refiners, industrial users, institutional investors, and retail participants all contribute information that influences prices. Although futures markets often play a leading role because of their liquidity, developments in physical supply and demand also affect pricing over time. Strong industrial consumption, mining disruptions, recycling trends, fabrication demand, investment flows, and macroeconomic conditions all contribute to the broader market environment. Industrial demand gives silver a unique position among precious metals. Silver is widely used in electronics, solar panels, medical equipment, automotive technologies, chemical processes, and numerous manufacturing applications because of its exceptional electrical and thermal conductivity. These industrial uses mean that silver demand is influenced not only by investment sentiment, but also by economic activity, technological innovation, and manufacturing trends. Investment demand and industrial demand can reinforce or offset one another depending on broader economic conditions. Mining supply introduces additional complexity. Silver is produced both from primary silver mines and as a byproduct of mining for metals such as copper, lead, and zinc. This means that silver production does not always respond directly to changes in silver prices. If most output comes as a byproduct, production decisions may depend more heavily on the economics of other metals than on silver itself. Recycling also contributes to total supply, with recovered silver coming from industrial scrap, jewelry, and other sources. Because silver serves multiple roles, market participants often interpret the same information differently. Rising industrial demand may be viewed as evidence of economic expansion by some observers, while others focus on inflation expectations, currency movements, or monetary policy. These differing interpretations contribute to price volatility, particularly during periods of economic uncertainty. It is also important to recognize that headlines about silver markets sometimes oversimplify complex developments. Statements suggesting that one event alone proves a broad market conclusion should be evaluated carefully and supported with credible data. Market structure involves exchanges, refiners, logistics, inventories, financing costs, regulations, and global trade flows. Individual events may be significant, but they are rarely sufficient by themselves to establish sweeping conclusions about the entire market. For investors, the distinction between physical and paper silver ultimately comes down to matching the investment vehicle with the intended objective. Those seeking direct ownership of tangible metal may prioritize physical bullion despite storage costs and lower convenience. Those seeking liquidity, trading flexibility, or hedging capabilities may find financial instruments more suitable. Some investors choose to combine both approaches, using physical holdings for long-term asset ownership while using financial products for tactical portfolio management. Understanding these differences encourages more informed decision making and reduces the likelihood of unrealistic expectations. Physical silver and paper silver are connected parts of the same broader market, but they are not identical products. They differ in ownership structure, liquidity, storage requirements, settlement mechanisms, costs, risks, and intended use. Recognizing those distinctions provides a stronger foundation for evaluating market developments, interpreting headlines, and participating responsibly in discussions about the silver market. To understand many of the discussions surrounding the silver market, it is essential to understand how the Comex delivery mechanism actually works. The system is often mentioned in financial news, investment reports, and market commentary, yet it is also one of the most misunderstood aspects of the precious metals market. Many investors hear terms like delivery, registered silver, eligible inventory, or warehouse receipts without knowing what those terms really mean. As a result, headlines can sometimes appear more dramatic than the underlying mechanics justify. A clear understanding of the delivery process provides valuable context for interpreting market developments and evaluating claims about supply, demand, and market structure. Comex is a futures exchange where standardized contracts for commodities including silver are traded, rather than functioning as a traditional retail marketplace where buyers simply purchase bars of silver and take them home. Comex primarily serves as a marketplace where participants manage price risk or gain exposure to price movements. The exchange brings together mining companies, refiners, manufacturers, financial institutions, traders, investment funds, and other participants, each with different objectives. Some seek to hedge future production or future purchases, while others speculate on price movements over relatively short periods. A futures contract is a standardized legal agreement between two parties. In the case of silver, one standard contract generally represents 5,000 troy ounces of silver meeting specific purity requirements established by the exchange. The contract also specifies the delivery month, approved warehouse locations, quality standards, and settlement procedures. Standardization allows contracts to trade efficiently because every participant understands the specifications before entering the market. One of the key features of futures markets is leverage. Rather than paying the full value of the silver represented by a contract, traders generally deposit an initial margin, which serves as a performance bond rather than a down payment. This allows participants to control a relatively large amount of silver exposure with substantially less capital than purchasing the equivalent quantity outright. While leverage increases capital efficiency, it also magnifies gains and losses, making risk management especially important. Every trading day, buyers and sellers enter and exit positions. Some traders hold positions for only minutes or hours, others maintain positions for weeks or months. Commercial firms may use futures contracts to hedge business operations, while investment funds may use them as part of broader portfolio strategies. Because positions are constantly opened and closed, the vast majority of contracts never reach the delivery stage. As a futures contract approaches its delivery month, market participants generally make one of several decisions. They may close the position by entering an offsetting trade, effectively canceling the obligation. They may roll the position into a later contract month if they wish to maintain exposure to silver prices. Or, if they meet the exchange requirements and intend to complete delivery, they may proceed through the delivery process established by Comex rules. The delivery mechanism itself is highly structured. Delivery does not usually involve trucks arriving at an exchange building carrying newly mined silver. Instead, the process is largely accomplished through documentation representing ownership of approved silver already stored in licensed depositories. These depositories are specialized vault facilities operated by approved organizations that meet strict exchange standards regarding security, record keeping, auditing, and handling procedures. Silver stored in Comex approved warehouses generally falls into two broad inventory categories known as eligible and registered. Understanding the distinction between these two categories is critical because confusion between them frequently contributes to misunderstandings about warehouse reports. Eligible silver refers to metal that meets Comex specifications regarding weight and purity and is stored within an approved warehouse. However, eligible silver is owned by private parties and has not been designated for delivery against futures contracts. Simply being physically present inside a Comex warehouse does not automatically make silver available for contract settlement. Owners may choose to keep the metal in storage for investment purposes, commercial inventory, financing arrangements, or future flexibility. Registered silver represents a different classification. Registered inventory also meets exchange specifications, but it has been assigned a warehouse receipt that makes it available for delivery against futures contracts. Registration does not necessarily indicate a change in physical location. In many cases, the same bar remains in exactly the same vault, while its legal status changes through documentation. The distinction between eligible and registered inventories is one reason warehouse reports require careful interpretation. A decrease in registered inventory does not necessarily mean silver has disappeared from the warehouse. Likewise, an increase in registered inventory does not necessarily indicate newly mined silver has arrived. Often, metal simply moves administratively between classifications depending on owner decisions and market conditions. Warehouse receipts play a central role in the delivery process. Rather than transporting physical bars every time ownership changes, approved warehouses issue electronic documentation representing specific quantities of qualifying silver. Ownership of these receipts can be transferred between parties while the metal remains securely stored. This system reduces logistical complexity and facilitates efficient settlement. The exchange clearing system helps coordinate obligations between buyers and sellers. Clearing members act as intermediaries, ensuring contractual obligations are fulfilled. Instead of individual traders relying directly on unknown counterparties, the clearing process centralizes financial responsibility and reduces counterparty risk through standardized procedures, financial safeguards, and ongoing monitoring. When delivery occurs, the seller submits a notice indicating intent to deliver against an eligible futures position. The buyer receiving assignment accepts ownership through the established procedures. Financial settlement accompanies the transfer of ownership documentation, completing the contractual obligation according to exchange rules. It is important to recognize that delivery is only one possible outcome of a futures contract. Most participants never intend to receive physical silver. For many commercial firms, futures contracts function primarily as hedging tools rather than purchasing mechanisms. A mining company may sell futures contracts months before production to reduce exposure to declining prices. A manufacturer expecting future silver needs may purchase contracts to help stabilize raw material costs. Investment firms may trade contracts based on macroeconomic expectations, inflation forecasts, currency movements, or technical analysis. Because different participants pursue different objectives, the futures market supports a much larger volume of trading activity than would occur if every contract required immediate physical delivery. This characteristic is common across many commodity futures markets, including agricultural products, energy commodities, and industrial metals. Open interest is another commonly discussed statistic. Open interest measures the number of outstanding contracts that remain active at a particular point in time. It does not indicate how many participants intend to take delivery. A high level of open interest reflects substantial market participation, but should not automatically be interpreted as evidence that equivalent quantities of physical silver will change ownership through delivery. Delivery notices provide additional insight into market activity. During delivery periods, the exchange publishes reports showing how many contracts have entered the delivery process. Analysts often compare these figures with warehouse inventories, historical patterns, and seasonal demand. Such comparisons can provide useful information, although they require careful interpretation within the broader context of market conditions. Another important concept involves first notice day. Traders holding long positions beyond this date may become eligible to receive delivery assignments, provided they satisfy applicable exchange requirements. Participants who do not intend to receive physical silver often close or roll their positions before first notice day arrives. This contributes to the relatively small percentage of contracts that proceed to physical settlement. Warehouse inventories themselves fluctuate over time. Metal may enter approved warehouses as refiners, investors, or commercial firms reposition holdings. Metal may leave warehouses when owners choose to remove it for fabrication, private storage, export, industrial consumption, or other purposes. Administrative changes between eligible and registered classifications also contribute to changing inventory reports without necessarily reflecting immediate physical movement. Financial commentators sometimes focus on inventory ratios, comparing outstanding futures contracts with registered warehouse stocks. These comparisons can generate discussion about market liquidity and delivery capacity, but they should be interpreted carefully. Futures markets operate with the understanding that not every contract results in physical delivery. Historical trading patterns consistently demonstrate that most participants offset or roll positions before delivery becomes necessary. Price discovery represents one of the exchange's most significant economic functions. Continuous trading incorporates information from thousands of market participants responding to interest rates, inflation expectations, industrial demand, mining supply, geopolitical developments, currency fluctuations, and macroeconomic data. The resulting futures prices influence commercial decisions throughout the global silver industry. Industrial users often monitor futures prices when planning purchases. Mining companies evaluate hedging opportunities based on forward price curves. Refiners assess inventory management decisions using market pricing signals. Investment managers analyze silver alongside other asset classes when constructing diversified portfolios. The exchange, therefore, performs functions extending well beyond physical settlement alone. Physical delivery nevertheless remains an essential component because it helps connect futures prices with underlying physical markets. The existence of an established delivery process creates an important relationship between financial contracts and tangible metal. If futures prices diverged substantially from physical market realities for extended periods, arbitrage opportunities could encourage transactions that help restore alignment. Another frequently misunderstood topic concerns default. In regulated futures markets, the term has a specific legal meaning involving failure to fulfill contractual obligations according to exchange rules. Headlines sometimes use the word loosely when discussing market stress or inventory changes. Distinguishing between formal contractual default and broader market speculation helps prevent confusion. Silver bars delivered through Comex must satisfy strict standards regarding purity, dimensions, identification markings, and approved refiners. These specifications promote consistency and confidence among market participants. Approved depositories maintain detailed records of stored metal, including serial numbers and ownership documentation, facilitating orderly transfers when delivery occurs. Auditing procedures also contribute to confidence in warehouse operations.